Imagine walking along a shoreline. You see waves rise and fall, never stopping, never completely predictable, yet following a rhythm. One wave crashes onto the sand, and then another comes behind it. You may not know exactly when the next wave will arrive, or how big it will be, but you know the pattern will continue. Financial markets are very much like these waves. They have their own rhythm, their own rise and fall. Sometimes the waves are gentle, almost imperceptible. Other times they crash with tremendous force, reshaping everything in their path. Markets and economies are driven by humans, and humans are driven by emotions, decisions, and interactions. Optimism fuels growth, fear triggers contraction, greed accelerates booms, caution slows them down. Yet even though each wave is unique, patterns emerge when we step back and observe carefully. Understanding these patterns is not about predicting the future with certainty. It is about recognizing where we are in the cycle, preparing for change, and making decisions that are rational rather than reactive. Howard Marks, a legendary investor, emphasizes that cycles are the heartbeat of investing. They explain why markets soar at some times and collapse at others. They reveal why businesses thrive in one era and struggle in the next. Most importantly, understanding cycles gives investors a framework to make smarter choices, reduce mistakes, and seize opportunities others overlook. This book is not a textbook filled with formulas and graphs alone. It is a guide to seeing the market as a living system, where the economy, profits, psychology, credit, and asset prices interact in a constantly moving cycle. By studying these cycles, we learn not only about markets, but also about human behavior, risk, and the forces that shape financial outcomes. As we begin, we start with a simple question. Why study cycles at all? Understanding the purpose behind studying cycles sets the stage for every insight that follows. It lays the foundation for seeing patterns, predicting changes, and positioning ourselves wisely in the financial world. Once we grasp the reason for studying cycles, we can move naturally into the first chapter, exploring their very nature and the lessons they hold. Chapter 1. Why study cycles? When we step into the world of investing, one of the first lessons we must learn is that markets are never linear. They do not rise in a straight line forever, nor do they fall without pause. Instead, they move in cycles, sometimes fast, sometimes slow, sometimes dramatic, sometimes subtle. Howard Marks begins this journey by asking a crucial question. Why should we study cycles at all? The answer is simple but profound. If we ignore cycles, we are left vulnerable to surprises. We might believe that high returns will continue endlessly, only to be caught off guard by a sudden downturn. Conversely, we might fear the market when prices are low, missing opportunities to invest at favorable levels. Understanding cycles allows us to step back and see the larger picture, rather than reacting emotionally to every rise and fall. Cycles exist everywhere, in nature, in human behavior, and in markets. Just as seasons change and day follows night, economies and financial markets rise and fall in predictable patterns. Booms are followed by busts, optimism by fear, abundance by scarcity. Investors who recognize these repeating patterns gain an advantage over those who focus solely on short-term movements. They understand that downturns are not permanent disasters, nor are booms permanent guarantees of wealth. Howard Marks emphasizes that studying cycles does not give us certainty. No one can predict the exact timing of a market peak or trough. But cycles provide context and perspective. They allow us to measure risk intelligently and take advantage of opportunities when others are blinded by emotion. For example, during periods of extreme optimism, investors often overlook risks. Prices become inflated, and mistakes are made. Conversely, in periods of fear and pessimism, markets can present extraordinary buying opportunities for those willing to look beyond short-term anxiety. Cycles also help us understand human psychology. Markets are driven not just by facts and data, but by the emotions of participants. Greed and fear, confidence and doubt, optimism and pessimism all swing back and forth like a pendulum. By studying cycles, we learn to anticipate these swings and position ourselves accordingly. we start to recognize the signs of euphoria, the moments of excessive caution, and the rare times when market behavior aligns with real economic conditions. Another reason to study cycles is that they help us avoid the trap of complacency. When markets are rising and returns are high, it is easy to assume that success will continue indefinitely. Investors may take excessive risks, confident that history will repeat itself in a straight line. But cycles remind us that nothing lasts forever. Peaks are followed by corrections, and periods of expansion eventually slow. By acknowledging this reality, we prepare ourselves to act wisely when conditions change. Finally, cycles are crucial for strategy and decision-making. Knowing where we stand in a cycle allows us to tilt our investments toward opportunities with favorable risk-reward ratios. It also helps us protect capital during periods of rising risk. Studying cycles is not about short-term timing. It is about positioning for long-term success, using knowledge of market rhythms to guide thoughtful and disciplined decisions. In essence, studying cycles is about seeing the market as a living system rather than a chaotic sequence of prices. It teaches patience, humility, and awareness. It helps us understand that booms and busts are natural, recurring, and inevitable. Those who embrace this knowledge are better equipped to navigate uncertainty, manage risk, and recognize opportunity when it appears. As we move to the next chapter, we will explore the nature of cycles more deeply. We will see why cycles exist, what shapes them, and how they reflect both human behavior and broader economic forces. Understanding their nature is the first step to mastering the market. Chapter 2. The Nature of Cycles. Markets, economies, and human behavior all move in cycles. Howard Marks explains that understanding the nature of cycles is the foundation of successful investing. Cycles are not random. They are natural, recurring patterns that arise from the interaction of economic forces, human psychology, and business dynamics. Recognizing these patterns allows investors to prepare, rather than react, to changes in the market. At its core, a cycle is a wave of change. It begins at one point, rises to a peak, reverses, and eventually reaches a low before starting the next wave. This rise and fall is seen everywhere. Economies expand and contract. Corporate profits increase and decrease. Investor sentiment swings from extreme optimism to deep fear. Even human behavior, from confidence to doubt, mirrors these oscillations. Cycles are the heartbeat of markets. Ignoring them is like trying to swim against a river without understanding its current. One of the reasons cycles exist is human psychology. Optimism and pessimism move like a pendulum. During good times, confidence grows, investors take more risks, and prices rise. As optimism reaches its extreme, caution fades and mistakes occur. Eventually, reality asserts itself. When things go wrong, fear takes over, investors become conservative, and markets fall. This psychological ebb and flow is predictable in pattern, if not in timing. Cycles are also driven by economic forces. Resources are limited, costs rise, competition intensifies, and growth slows. These natural constraints prevent any boom from lasting forever. Conversely, recessions create scarcity and fear, which eventually lead to opportunity and recovery. Marx emphasizes that cycles are not isolated to finance alone. They are part of a broader pattern in life and nature, from the changing seasons to the rise and fall of empires. Understanding the nature of cycles helps investors see patterns where others see chaos. It allows them to differentiate between temporary setbacks and long-term trends. It also teaches patience. Success in investing is rarely about acting at every moment. It is about waiting for the right conditions, recognizing extremes, and making thoughtful decisions. By appreciating the nature of cycles, we understand that downturns are not permanent and booms are not guaranteed. Another aspect of cycles is their interaction. Economic conditions, corporate profits, credit availability, and investor psychology all influence each other. A strong economy may boost profits, which fuels investor optimism, which drives credit expansion. Likewise, a slowing economy can reduce profits, trigger fear, and tighten credit. Recognizing these interactions gives investors a broader perspective and helps them anticipate possible market movements. Howard Marks reminds us that cycles teach humility. No one can control the market, and no one can predict its timing perfectly. But by studying the patterns and understanding their nature, we can tilt the odds in our favor. We learn to recognize extremes, avoid overconfidence, and seize opportunities when fear dominates. This mindset is what separates thoughtful, disciplined investors from those who are reactive and emotional. As we move to the next chapter, we will explore the regularity of cycles. While no cycle is perfectly predictable, patterns do repeat. Understanding this regularity allows investors to anticipate shifts, position themselves strategically, and navigate the market with greater confidence. The journey from understanding the nature of cycles to recognizing their regularity is the next step in mastering market behavior. Chapter 3. The Regularity of Cycles. While cycles are natural and recurring, Howard Marks explains that they are not perfectly regular. No one can predict the exact timing of peaks or troughs, and no two cycles are exactly alike. Yet there is a regularity in their pattern that provides guidance for thoughtful investors. Understanding this regularity is crucial for positioning and decision-making in financial markets. The regularity of cycles comes from the fact that human behavior and economic forces are relatively consistent over time. Optimism grows when markets rise, and pessimism dominates when markets fall. Credit expands during booms and contracts during busts. Profits move up and down with demand and competition. These recurring behaviors create recognizable waves, even if the timing and magnitude vary. Investors who understand this pattern can see beyond daily noise and anticipate broader trends. Marx emphasizes that the regularity of cycles does not mean predictability in exact dates. We may know that a cycle will eventually peak, but we cannot know the exact day or month. Similarly, we can recognize a trough approaching, but the precise timing is uncertain. The value lies not in prediction, but in context and perspective. By knowing roughly where we are in a cycle, we can make smarter decisions, tilt our portfolios appropriately, and reduce emotional errors. One way to see regularity is by observing historical patterns. Over decades, markets have shown repeated sequences of expansion, peak, contraction, and recovery. During expansions, investors often underestimate risk. Credit grows, and prices rise beyond fundamentals. At peaks, euphoria dominates. Then reality intervenes. When contractions begin, fear spreads, liquidity tightens, and prices fall sharply. Eventually, recovery starts, optimism returns, and the cycle begins anew. Recognizing these phases helps investors prepare rather than panic. Another key point Marx makes is that cycles are interconnected across different areas. Economic growth, profits, investor psychology, and credit conditions interact to create the rhythm of markets. A peak in one area often coincides with peaks in others. Similarly, a trough in economic activity may coincide with low investor confidence and tight credit. Understanding this interplay increases the reliability of observing patterns and makes it easier to anticipate potential turning points. The regularity of cycles also teaches an important lesson in risk management. Extreme optimism and rising asset prices often indicate higher risk, while extreme pessimism and falling prices may signal opportunity. Investors who ignore these patterns are often caught off guard, buying at the top and selling at the bottom. Those who understand the regularity of cycles can act contrarily to the herd, buying when others fear and selling when others chase prices blindly. Marx also stresses that cycles are not uniform in length or amplitude. Some booms are short and sharp, while others are long and steady. Similarly, recessions vary from mild slowdowns to severe contractions. By studying many cycles over time, investors can appreciate this variability while still recognizing the underlying patterns. The lesson is humility. No one can perfectly time the market, but understanding the regularity gives a significant edge. As we move to the next chapter, we will explore the economic cycle in detail. While understanding the nature and regularity of cycles is crucial, the economy itself is the primary engine driving many of these patterns. Recognizing how economic expansions and contractions influence markets helps investors connect theory to real-world behavior and make informed investment choices. Chapter 4. The Economic Cycle. At the heart of all market behavior lies the economic cycle. Howard Marks explains that understanding the economic cycle is essential because it drives profits, credit, investor psychology, and asset prices. The economy moves through periods of expansion and contraction, creating the rhythm of growth and decline that shapes the financial world. Recognizing these phases allows investors to act with perspective rather than react to short-term fluctuations. An economic expansion begins when businesses invest, consumers spend, and employment rises. During these periods, optimism grows. Companies hire more workers, production increases, and profits generally rise. Credit is more easily available, fueling further growth. Investors feel confident, markets rise, and wealth accumulates. Expansion often feels self-sustaining, and people begin to believe that good times will last forever. Yet, expansions are never permanent. As resources become scarcer, costs rise, and competition intensifies, growth slows. Eventually, excess is built up during the boom, whether in debt, valuations, or speculation, begin to correct. This slowdown can take many forms: rising inflation, increasing interest rates, declining profits, or reduced consumer spending. Marx emphasizes that recognizing the signs of a slowing economy is crucial for prudent investing. The contraction phase, or recession, is the natural counterpart to expansion. During contractions, optimism fades, businesses cut back, and layoffs may occur. Credit tightens, profits decline, and markets fall. This period is often uncomfortable and creates fear among investors. Yet it is also a necessary part of the cycle. Contractions clear out excesses, correct imbalances, and create conditions for the next phase of expansion. Understanding this natural ebb and flow helps investors maintain perspective and avoid panic during downturns. Howard Marks highlights that the economic cycle interacts closely with human behavior. During expansions, confidence can lead to overestimation of safety, excessive borrowing, and inflated asset prices. During contractions, fear can lead to extreme caution, selling at low prices, and missed opportunities. By observing the economy, investors can better anticipate shifts in sentiment and risk appetite, positioning themselves strategically rather than emotionally. Another important aspect of the economic cycle is timing and duration. No two cycles are exactly alike. Some expansions last years and end gradually, while others are brief and abrupt. Recessions can be mild or severe, short or prolonged. Marx stresses that while the timing of a cycle cannot be predicted precisely, recognizing its phase is far more valuable than attempting to forecast exact dates. Awareness of where we are in the cycle allows investors to manage risk and allocate resources effectively. The economic cycle also drives other cycles. Profits, credit, real estate, and investor psychology all reflect the broader economic environment. For example, during expansion, credit is plentiful and real estate values often rise. During contraction, lending tightens and real estate markets may stall. Marx encourages investors to look at the economy as the central engine, with other cycles as interconnected gears that respond to its motion. Finally, understanding the economic cycle instills discipline and patience. Investors learn that no period of growth lasts forever, and no downturn lasts indefinitely. Booms should be approached with caution, and busts can present opportunities for those willing to act thoughtfully. The economic cycle is not a threat to investors. It is a guide, providing insight into timing, risk, and opportunity. As we move to the next chapter, we will examine government involvement with the economic cycle. While the economy has its natural rhythm, governments and central banks intervene to influence growth, control inflation, and stabilize markets. Chapter 5. Government involvement with the economic cycle. While the economic cycle moves naturally, Howard Marks emphasizes that governments and central banks play an important role in influencing its rhythm. Through policies, regulations, and interventions, they attempt to soften downturns, control inflation, and sustain growth. Understanding this involvement helps investors anticipate how external forces can amplify or dampen market cycles. Central banks, such as the Federal Reserve, manage monetary policy by adjusting interest rates and controlling the money supply. When the economy slows, they may lower rates, making borrowing cheaper. This encourages businesses to invest, consumers to spend, and credit to expand. Conversely, during periods of rapid growth, central banks may raise rates to prevent inflation and moderate excessive optimism. Marx explains that these actions do not eliminate cycles, but they can influence their severity and duration. Fiscal policy is another tool governments use to affect the economic cycle. Through spending programs, tax policies, and subsidies, governments can stimulate demand during slow periods or restrain it during overheated phases. For example, infrastructure projects can create jobs and boost economic activity during a slowdown. Tax cuts can increase consumer spending, while tax increases can cool an overheating economy. These interventions, while helpful, often create unintended consequences that investors need to recognize. Marx cautions that government intervention can sometimes distort natural market signals. For instance, artificially low interest rates can encourage excessive borrowing, inflating asset prices and creating vulnerabilities. Similarly, bailouts and stimulus programs may delay the correction of imbalances, leading to larger adjustments later. Investors who ignore the effects of policy may misjudge risk and opportunity, assuming that markets are driven purely by fundamentals rather than by policy-induced forces. Despite their influence, governments cannot fully control the cycle. Human behavior, market psychology, and economic realities still play dominant roles. Policies can ease recessions or moderate booms, but they cannot prevent cycles from occurring. Recognizing the limits of intervention helps investors avoid overconfidence and remain cautious even during periods of apparent stability. Marx also highlights the importance of understanding the timing of policy actions. Often, there is a lag between when policies are enacted and when their effects are felt in the economy and markets. Investors who are aware of these lags can better anticipate potential market reactions and adjust their strategies accordingly. Timing, therefore, becomes as important as understanding the nature of the intervention itself. Another key point is that government actions can influence multiple cycles simultaneously. For example, lowering interest rates affects credit, real estate, and equity markets while boosting investor sentiment. Similarly, regulatory changes can impact corporate profits and investment behavior. Understanding these connections allows investors to see the broader picture rather than focusing on a single market segment. Finally, Marx reminds us that government involvement is not inherently good or bad. It is a force to understand and account for in investment decisions. Wise investors consider how interventions may amplify or moderate cycles, and they adjust their risk and positioning accordingly. By studying both natural market behavior and policy influence, investors gain a more complete view of market dynamics. As we move to the next chapter, we will explore the cycle in profits. Corporate earnings are deeply influenced by both the natural economic cycle and government actions, and understanding their patterns is essential for making informed investment choices. Chapter 6. The Cycle in Profits. Corporate profits are at the core of investing, and Howard Marks emphasizes that they move in cycles just like the economy. Understanding the cycle in profits is crucial because profits drive stock prices, valuations, and investor behavior. Ignoring profit cycles can lead to overpaying for businesses in good times or missing opportunities in bad times. During economic expansions, profits typically rise. Increased demand boosts sales, margins improve, and companies generate more cash. Investor optimism grows as earnings reports beat expectations, and markets often respond with rising stock prices. In these periods, it is easy to feel that high profits will continue indefinitely. Businesses may overextend, borrowing to expand aggressively, assuming that favorable conditions will last forever. However, profits do not grow in a straight line. As the cycle progresses, competition intensifies. Costs rise, market saturation occurs, and growth slows. Even strong businesses eventually face pressure on margins. Marx explains that investors often fail to recognize these shifts, assuming that past performance guarantees future returns. This overconfidence can lead to excessive risk-taking and inflated valuations. During economic contractions, profits typically fall. Reduced consumer demand, higher borrowing costs, and tighter credit conditions squeeze margins. Some companies may face losses, layoffs, or even bankruptcy. Investor sentiment turns cautious or fearful, often exaggerating declines in stock prices. Marx highlights that downturns in profits are a natural part of the cycle, and recognizing them as temporary rather than permanent can prevent panic selling. The profit cycle also varies by industry. Some sectors are highly cyclical, such as technology, energy, and commodities, where profits swing dramatically with economic conditions. Other sectors, like utilities or consumer staples, are more stable, showing smaller fluctuations. Investors who understand the relative cyclicality of industries can position their portfolios to manage risk and capitalize on opportunities. Marx emphasizes that profit cycles are not just about numbers. They reflect broader economic conditions, human psychology, and market dynamics. Rising profits reinforce optimism, which fuels higher valuations and risk-taking. Declining profits amplify fear, prompting selling and sometimes creating undervalued opportunities. Profits act as both a signal and a driver of market behavior, linking the economic and psychological aspects of cycles. Another key point is that corporate decisions amplify the cycle. During booms, companies invest aggressively, hire rapidly, and expand production. During downturns, they cut costs, reduce investments, and delay hiring. These actions, while rational for individual companies, collectively magnify the cyclical swings of profits and markets. Understanding this feedback loop helps investors anticipate changes and position themselves wisely. Finally, Marx advises that successful investing requires awareness of profit cycles, rather than attempting to time exact peaks or troughs. By observing trends, understanding the causes of profit expansion or contraction, and considering market sentiment, investors can make better decisions. Patience, discipline, and perspective are key. Recognizing that profits rise and fall naturally allows investors to avoid panic in downturns and restraint in booms. As we move to the next chapter, we will explore the pendulum of investor psychology. Profits, while essential, are only part of the story. How investors perceive and react to profits, risks, and opportunities shapes the market cycle in powerful ways. Understanding the psychology behind these swings is the next step in mastering market cycles. Chapter 7. The Pendulum of Investor Psychology. Howard Marks emphasizes that one of the most powerful forces in markets is human psychology. He describes it as a pendulum, swinging back and forth between extreme optimism and extreme pessimism. Understanding the pendulum of investor psychology is essential because emotions, more than fundamentals, often drive market behavior. Greed and fear, confidence and doubt, euphoria and panic shape prices, risk tolerance, and decision-making in ways that numbers alone cannot explain. During periods of optimism, the pendulum swings toward confidence. Investors feel secure, believing that growth will continue indefinitely. Markets rise, credit is easily available, and risk-taking increases. Profits are strong, valuations expand, and the sense of safety encourages more aggressive behavior. People forget that cycles exist, assuming that good times will last forever. Marx warns that this is often when mistakes are made. Overconfidence leads to excessive borrowing, speculative investments, and inflated asset prices. Conversely, during periods of pessimism, the pendulum swings toward fear. Markets fall, profits decline, and investors become risk-averse. Confidence erodes, and even fundamentally strong businesses may be undervalued. Credit tightens, and economic activity slows. Panic can drive asset prices below intrinsic value, creating opportunities for those willing to act rationally when others are emotional. Marx explains that fear, while uncomfortable, is a necessary corrective force in markets, restoring balance and setting the stage for the next cycle. The pendulum is influenced not only by facts, but also by perception. Human beings are naturally prone to herd behavior. When others are buying aggressively, it feels safe to follow. When others are selling in panic, it feels dangerous to hold. Marx highlights that understanding this tendency allows investors to take contrarian positions, buying when others fear, and selling when others chase euphoria. Investor psychology interacts with other cycles. Rising profits, easy credit, and government policies can amplify optimism. Conversely, falling profits, tight credit, and economic slowdown intensify fear. The pendulum does not move in isolation. It responds to economic realities, policy decisions, and historical memory of past cycles. Recognizing these connections helps investors anticipate the mood of the market and position themselves strategically. Marx also emphasizes that swings in psychology are rarely balanced. Optimism tends to overshoot, creating booms, while pessimism often exaggerates declines, producing undervalued opportunities. Extreme swings are where the greatest risks and rewards exist. Investors who fail to recognize the pendulum risk being swept along with the crowd, buying at peaks and selling at troughs. Those who understand it can profit from the natural ebb and flow of sentiment. Finally, the pendulum teaches humility. No investor is immune to emotion, and even experienced professionals can be influenced by market sentiment. Awareness, discipline, and patience are essential. By observing the pendulum, understanding where it currently stands, and resisting the urge to follow the herd, investors can navigate cycles more successfully. As we move to the next chapter, we will explore the cycle in attitudes toward risk. Psychology shapes not only how investors feel, but also how they approach risk. Recognizing how risk appetite expands and contracts during different phases of the market is the next step in mastering cycles and making informed decisions. Chapter 8. The Cycle in Attitudes Toward Risk. Howard Marks explains that risk is not constant. It moves in cycles, just like markets, profits, and investor psychology. Understanding the cycle in attitudes toward risk is essential because perception of risk drives behavior, influences prices, and creates opportunities for disciplined investors. How investors feel about risk often differs dramatically from the actual level of risk in the market. During periods of economic expansion and market growth, optimism dominates. Investors feel confident, credit is easily available, and risk appears low. They borrow more, invest aggressively, and take on leverage without fully appreciating potential downsides. Asset prices rise, sometimes to levels disconnected from fundamentals. Marx points out the irony. Risk is often highest when everyone believes it is lowest. The perception of safety can be misleading. Conversely, during economic contraction or market decline, fear takes over. Investors perceive risk as high, even when asset prices are attractive. They may sell in panic, avoid opportunities, or refuse to take on what could be calculated risk. In reality, risk may be lower than it seems, as prices have adjusted and potential losses are limited. Marx emphasizes that extreme fear can create the best opportunities for long-term investors who remain rational and disciplined. This cyclical behavior in risk perception is closely tied to psychology. When markets are booming, optimism overshadows caution. During downturns, fear overshadows rational analysis. Investors tend to overreact in both directions, leading to overshooting at the peaks and undershooting at the troughs. Recognizing this pattern helps investors avoid emotional mistakes and position themselves advantageously. Marx also explains that the risk cycle is not uniform across all assets. Some investments, such as speculative technology stocks or high-yield bonds, are highly sensitive to changes in perceived risk. Others, like government bonds or stable dividend-paying companies, are less volatile. Understanding how risk perception varies across markets allows investors to allocate capital effectively, reducing exposure when sentiment is excessive and increasing it when fear dominates. Another key point is that risk is both objective and subjective. Objective risk exists in the underlying fundamentals, leverage, market conditions, or economic weakness. Subjective risk is how investors perceive these factors. The cycle in attitudes toward risk often exaggerates the difference between perception and reality. Marx advises investors to focus on objective risk, using cycles as a guide to identify when subjective fear or greed is creating opportunities or threats. Successful investors embrace the cyclical nature of risk. They are cautious when others are careless and brave when others are fearful. By observing risk perception, they can anticipate changes in market behavior and act contrary to prevailing sentiment. Marx stresses that this approach is not about predicting exact tops or bottoms, but about positioning intelligently in alignment with the market cycle. As we move to the next chapter, we will explore the credit cycle. Credit is the lifeblood of modern economies, and changes in lending behavior influence risk, asset prices, and investor psychology. Understanding the credit cycle is essential for managing risk and identifying opportunities across economic phases. Chapter 9. The Credit Cycle. Howard Marks emphasizes that credit is a critical driver of market cycles. The availability, cost, and terms of credit influence economic growth, corporate profits, and investor behavior. Understanding the credit cycle is essential because it shapes risk-taking, asset prices, and market sentiment, and often amplifies the swings of the broader economic and profit cycles. During periods of economic expansion, credit is abundant and cheap. Banks and lenders are willing to provide loans easily, interest rates are low, and investors have access to leverage. Businesses borrow to expand operations, consumers borrow to buy homes and goods, and financial markets see increased investment activity. Optimism fuels risk-taking, asset prices rise, and profits grow. Marx points out that during this phase, investors often underestimate risk, assuming that easy credit will continue indefinitely. However, credit cycles eventually reverse. When the economy slows, or defaults rise, lenders tighten standards. Interest rates may increase, borrowing becomes more expensive, and access to capital decreases. This contraction in credit amplifies economic slowdown, depresses profits, and creates fear in markets. Investors may sell assets to reduce debt, even if fundamentals remain strong. Marx emphasizes that the timing and severity of credit tightening are unpredictable, but their impact is profound, often deepening market downturns. The credit cycle is closely linked to investor psychology. When credit is plentiful, optimism rises, leverage expands, and risks appear smaller than they are. During tight credit periods, fear dominates, and investors become excessively cautious. This oscillation magnifies the natural swings of other cycles, such as profits, real estate, and equity markets. Understanding how credit availability affects sentiment allows investors to anticipate market moves and make informed decisions. Marx also highlights that the credit cycle is self-reinforcing. Easy credit encourages borrowing, which fuels spending and asset purchases, driving markets higher. Conversely, tight credit forces deleveraging, reducing liquidity, slowing economic activity, and pushing markets lower. Recognizing these patterns helps investors understand that market extremes often coincide with peaks or troughs in credit availability. Another important point is that not all credit is equal. Different types of debt, corporate loans, high-yield bonds, consumer debt, or mortgages, respond differently to economic conditions. Investors need to understand which sectors are most sensitive to credit cycles to manage risk effectively. Marx stresses that cycles in credit create both danger and opportunity. Those who ignore them risk losses, while those who study them can profit from dislocations in the market. Finally, understanding the credit cycle teaches discipline. Investors learn to be cautious when leverage is high and optimism is rampant, and to be opportunistic when credit tightens and fear dominates. By integrating knowledge of credit with insights from economic, profit, and psychological cycles, investors gain a powerful framework for navigating markets intelligently. As we move to the next chapter, we will explore the distressed debt cycle. This specialized aspect of credit reveals how extreme market stress creates opportunities to acquire undervalued assets, highlighting the interplay of risk, psychology, and cycles in action. Chapter 10. The Distressed Debt Cycle. Howard Marks explains that the distressed debt cycle is a unique and extreme phase of the broader credit cycle. It occurs when borrowers cannot meet their obligations, and the market for debt becomes stressed or dysfunctional. Understanding this cycle is essential because it creates both heightened risk and exceptional opportunities for disciplined investors who can navigate the turmoil. During normal periods, most companies can meet their debt obligations, and credit flows smoothly. But during economic slowdowns, recessions, or financial crises, certain borrowers struggle to repay. Defaults rise, credit tightens, and lenders become highly selective. Interest rates on risky debt spike, and liquidity dries up. Investors often panic, selling distressed assets at steep discounts. Marx emphasizes that this phase can be terrifying for many, but it is also where opportunity emerges. The distressed debt cycle is closely tied to human psychology. Fear dominates, and market participants often act irrationally. They may overestimate the risk of loss, undervalue assets, or flee markets entirely. Conversely, a few disciplined investors, guided by careful analysis rather than emotion, can identify undervalued opportunities and profit when the cycle turns. Marx stresses that understanding investor behavior in these moments is as important as understanding the financial fundamentals of distressed companies. Distressed debt is also highly sensitive to the broader economic and credit cycles. When credit tightens, even moderately leveraged companies may struggle. When the economy contracts, businesses with weak balance sheets face bankruptcy. These conditions amplify the pendulum swings of risk perception. Investors who recognize where the market stands in the distressed debt cycle can buy assets at significant discounts and wait for recovery, often earning exceptional returns. Marx highlights that navigating distressed debt requires patience, discipline, and a long-term perspective. It is not for the faint-hearted. Investors must conduct thorough analysis, distinguish between temporary distress and permanent failure, and be willing to hold positions until the market recovers. Timing is crucial, but understanding the cycle reduces reliance on exact predictions and increases the likelihood of successful investment outcomes. Another key point is that distressed debt often intersects with other cycles. For example, economic downturns may depress corporate profits, amplify investor fear, and tighten credit. Real estate cycles may push property-backed loans into distress. Recognizing these interconnections allows investors to anticipate stress points and identify opportunities before the broader market reacts. Finally, Marx teaches that the distressed debt cycle is a reminder of the cyclical nature of risk and opportunity. Extreme fear and dysfunction create the potential for outsized returns for those who remain rational and prepared. It reinforces the principle that understanding cycles, economic, credit, profit, and psychological, is the cornerstone of successful investing. Those who study these patterns gain an edge over investors who react emotionally to volatility and distress. As we move to the next chapter, we will explore the real estate cycle. Real estate, like corporate profits and credit, moves in identifiable phases, reflecting both economic conditions and investor psychology. Understanding these patterns helps investors navigate one of the largest and most influential asset markets in the economy. Chapter 11. The Real Estate Cycle. Howard Marks explains that real estate, like other assets, moves in predictable cycles. Understanding the real estate cycle is crucial because it is heavily influenced by economic conditions, credit availability, investor psychology, and government policy. Real estate cycles can be long and drawn out, but they have a profound impact on wealth creation, borrowing, and market behavior. The real estate cycle typically begins with recovery. After a period of oversupply or declining prices, demand starts to rise. Employment grows, interest rates may be favorable, and consumers regain confidence. Investors and developers begin buying properties or initiating new projects. Prices start to stabilize, signaling that the market has moved past the bottom. Marx emphasizes that recognizing the early recovery phase is key to acquiring assets at favorable prices. As the cycle progresses, the expansion phase gains momentum. Prices rise steadily, rents increase, and investment activity accelerates. Optimism spreads, and credit is widely available. Developers may start new construction projects, often anticipating continued growth. During this phase, leverage and speculation can increase as investors assume that rising prices will continue indefinitely. Marx cautions that this is often when risk is underestimated, and overbuilding or overleveraging can occur. Eventually, the market reaches a peak. Supply may exceed demand due to overbuilding, and prices rise faster than fundamentals justify. Optimism is high, and investors feel confident that real estate values will keep increasing. Marx points out that history shows peaks are often followed by painful corrections. Misjudging the timing of the peak or ignoring signs of overheating can result in significant losses. The contraction phase follows the peak. Prices stabilize or decline, credit tightens, and investors become cautious. Occupancy rates may fall, rents may drop, and developers may halt new projects. Economic slowdown can worsen these effects, and the market may experience distress or foreclosures. Marx emphasizes that while this phase can be challenging, it also creates opportunities for disciplined investors who can buy undervalued properties at discounted prices. Investor psychology plays a crucial role in the real estate cycle. During booms, confidence is high, leverage is widely used, and speculative behavior peaks. During downturns, fear dominates, and many avoid investment altogether, often selling at low prices. Recognizing these swings helps investors act contrary to the herd, buying when fear is high and exercising caution when optimism is extreme. The real estate cycle is closely linked to other market cycles. Credit availability, economic growth, and interest rates heavily influence real estate prices. For example, low interest rates can fuel demand and support higher valuations, while tight credit can constrain buyers and depress prices. Understanding these interactions provides investors with a holistic view, allowing them to anticipate turning points more effectively. Marx emphasizes that the key to success in real estate investing is patience, careful analysis, and awareness of the cycle. Timing matters, but more important is recognizing where the market stands in its cycle and adjusting risk and strategy accordingly. Investors who understand the real estate cycle can avoid mistakes, seize opportunities, and create long-term value even during turbulent periods. As we move to the next chapter, we will explore putting it all together, the market cycle. Real estate, credit, profits, psychology, and economic forces are interconnected, and understanding how these cycles interact gives investors a complete framework for navigating markets wisely. Chapter 12. Putting it all together, the market cycle. Howard Marks explains that while we have examined individual cycles, economic, profit, credit, distressed debt, real estate, and investor psychology, they do not exist in isolation. Understanding the market cycle as a whole is essential because these cycles interact, overlap, and influence one another, creating the rhythm of markets. Recognizing this interconnectedness allows investors to make more informed decisions, manage risk effectively, and identify opportunities. The market cycle is the cumulative effect of various forces. Economic expansions fuel corporate profits, which boost investor confidence and asset prices. Abundant credit amplifies this optimism, enabling greater leverage and investment. Real estate markets rise, stocks climb, and even speculative investments flourish. During this phase, risk appears low, and many investors feel secure. Marx emphasizes that these periods often mask underlying vulnerabilities, which may only become apparent when a cycle turns. Conversely, during market contractions, negative forces reinforce each other. Slowing economic growth reduces corporate profits, tightening credit limits borrowing, and declining asset prices amplify investor fear. The distressed debt cycle may emerge as companies struggle to meet obligations. Real estate values may fall, and pessimism dominates markets. Marx highlights that recognizing the interaction of these forces allows disciplined investors to anticipate potential turning points and act strategically. Investor psychology plays a critical role in connecting all cycles. The pendulum of emotion amplifies both growth and decline. When optimism peaks, risk-taking surges, leverage increases, and prices may overshoot intrinsic value. When fear dominates, selling accelerates, markets fall sharply, and undervalued opportunities appear. Understanding how psychology interacts with economic and financial factors is crucial to mastering the market cycle. Marx also stresses that timing is important, but should not be the sole focus. Attempting to predict exact tops and bottoms is nearly impossible. Instead, investors should focus on cycle positioning, recognizing whether conditions are generally favorable or risky. This allows them to adjust portfolios, manage leverage, and approach opportunities with an informed perspective rather than reacting emotionally. Another key insight is that cycles are irregular in duration and magnitude. Some expansions are long and steady, while others are short and sharp. Recessions can be mild or severe. Investors who study history and observe patterns gain perspective, understanding that extremes, both optimism and pessimism, offer both risk and opportunity. Marx emphasizes that humility is critical. Even experienced investors cannot control cycles, but they can prepare and respond intelligently. Putting all cycles together also highlights interconnections. For example, the credit cycle influences real estate, corporate profits, and investor behavior. Economic growth shapes profits, which influence sentiment and risk-taking. Understanding these linkages allows investors to see the bigger picture and avoid being misled by isolated data points or short-term fluctuations. Finally, Marx reminds us that mastering the market cycle requires both knowledge and discipline. Recognizing patterns, understanding interactions, and observing psychology are all tools. Patience, rationality, and a long-term perspective enable investors to act when others are fearful, avoid mistakes when others are greedy, and achieve superior results over time. As we move to the next chapter, we will explore how to cope with market cycles. Understanding cycles is one thing. Effectively navigating them is another. Marx provides practical guidance on managing risk, positioning assets, and making decisions that align with the natural rhythm of markets. Chapter 13. How to cope with market cycles. Howard Marks emphasizes that understanding market cycles is only the first step. The real challenge is coping with them effectively. Investors face constant uncertainty, swings in asset prices, and changing risk perceptions. Success comes from preparing for cycles, managing behavior, and positioning portfolios to withstand volatility while seizing opportunities. One key principle is acknowledging that cycles exist. Many investors ignore or underestimate market cycles, believing that growth or decline will continue indefinitely. Marx warns that this mindset leads to poor decisions, such as buying at peaks or selling at troughs. By recognizing that booms and busts are inevitable, investors can approach markets with humility and caution, making more rational choices. Another principle is risk management. Investors should avoid overexposure during periods of extreme optimism when risk is underestimated. Using diversification, limiting leverage, and maintaining liquidity helps protect portfolios during downturns. Conversely, periods of pessimism and fear may present opportunities to take calculated risks, buy undervalued assets, or increase exposure in areas likely to recover. Marx stresses that coping with cycles is about balancing caution and opportunity intelligently. Investor psychology is central to coping. During booms, it is tempting to follow the herd, increasing exposure and ignoring fundamentals. During downturns, fear can lead to panic selling and missed opportunities. Marx advises investors to resist emotional impulses by focusing on facts, long-term objectives, and the underlying value of assets rather than short-term price movements. Discipline is critical. Patience is another crucial tool. Markets rarely move in straight lines, and cycles often last longer than expected. Investors who overreact to short-term volatility may harm their long-term returns. By maintaining a long-term perspective, understanding where the market stands in its cycle, and acting deliberately, investors can navigate volatility without unnecessary stress or loss. Cycle positioning is also important. Marx encourages investors to evaluate whether conditions are favorable or risky based on economic trends, profit patterns, credit conditions, and sentiment. Adjusting portfolios to reflect cycle positions, reducing exposure during peak optimism, increasing exposure during fear, improves risk-adjusted returns. This does not require perfect timing, only informed judgment and awareness of prevailing conditions. Another coping strategy is learning from history. Past cycles provide valuable lessons about patterns, behaviors, and outcomes. By studying historical booms, busts, and credit crises, investors can anticipate potential pitfalls and recognize opportunities that others might overlook. Historical perspective builds confidence and reduces emotional reactions to current market swings. Finally, Marx stresses that coping with cycles is a combination of knowledge, discipline, and humility. Accept that the market will always have uncertainty, resist overconfidence, and focus on controlling what is within your power. Risk management, patience, and informed decision-making. Investors who master these skills navigate cycles successfully, capitalizing on opportunities while avoiding costly mistakes. As we move to the next chapter, we will explore cycle positioning. While coping focuses on behavior and risk management, positioning involves proactive decisions to align portfolios with the current stage of the market cycle. Understanding this allows investors to tilt exposure wisely and enhance long-term performance. Chapter 14. Cycle Positioning. Howard Marks explains that understanding cycles is valuable, but positioning your investments according to the stage of the cycle is what separates successful investors from the rest. Cycle positioning is about making proactive decisions that reflect current and anticipated market conditions. It is not about predicting exact tops or bottoms, but about managing exposure, risk, and opportunity intelligently. During periods of optimism, when economic growth is strong, profits are rising, and credit is easy, cycle positioning requires caution. Investors may be tempted to chase returns, leverage heavily, or ignore risks. Marx warns that this is when losses are most likely, as the market often overestimates future growth and underestimates potential dangers. Reducing exposure to speculative or high-risk assets, limiting leverage, and focusing on quality investments are key strategies in these phases. Conversely, during periods of pessimism, when fear dominates, profits are declining, and credit is tight, cycle positioning encourages opportunistic behavior. Assets may be undervalued, market sentiment is negative, and risk premiums are high. Marx emphasizes that disciplined investors can increase exposure to high-quality assets, distressed opportunities, or sectors likely to recover. Acting contrary to prevailing sentiment, when backed by careful analysis, can produce superior long-term returns. Marx highlights that cycle positioning is not static. Markets do not remain in one phase indefinitely. Expansions may be prolonged or short-lived, and contractions vary in severity. Investors must continuously assess indicators such as economic growth, credit conditions, corporate profits, and investor psychology to adjust positions appropriately. Flexibility and adaptability are central to effective positioning. Another important point is that cycle positioning is relative. Investors should not focus solely on absolute returns, but also consider risk-adjusted outcomes. Avoiding losses during downturns can be as valuable as achieving gains during booms. By positioning carefully, investors can protect capital when markets are risky and seize opportunities when others are fearful. This approach reduces the emotional stress of investing and improves long-term performance. Marx also stresses the role of diversification and asset allocation in cycle positioning. By spreading investments across sectors, asset classes, and geographies, investors reduce vulnerability to cyclical swings in any single market. Strategic allocation allows participation in growth while limiting exposure during downturns. Finally, cycle positioning requires a long-term perspective. Short-term market movements are often unpredictable, but understanding the stage of the cycle and positioning accordingly increases the probability of success over time. Discipline, patience, and an awareness of how economic, credit, profit, and psychological cycles interact provide a framework for making informed decisions, managing risk, and capitalizing on opportunities. As we move to the next chapter, we will explore limits on coping. While investors can position themselves according to cycles, there are natural constraints and uncertainties that require humility and careful management of expectations. Recognizing these limits helps investors avoid overconfidence and overreach. Chapter 15. Limits on coping. Howard Marks emphasizes that while understanding market cycles and positioning accordingly is powerful, there are limits to how much investors can control outcomes. Markets are influenced by numerous unpredictable factors, including human behavior, policy decisions, and external shocks. Recognizing these limits is essential for maintaining humility, discipline, and realistic expectations. One key limitation is the unpredictability of timing. Even if an investor correctly identifies the stage of a cycle, the exact turning point, whether a market peak or trough, is nearly impossible to predict. Acting too early or too late can reduce potential gains or increase losses. Marx stresses that investors should focus on positioning and risk management rather than attempting to time the market perfectly. Another constraint is external events. Natural disasters, geopolitical crises, sudden regulatory changes, or unexpected economic shocks can disrupt even the most carefully analyzed cycles. While knowledge of cycles improves decision-making, it cannot eliminate exposure to unforeseen events. Investors must accept that uncertainty is inherent in markets and build resilience through diversification, liquidity, and conservative leverage. Behavioral limitations also play a role. Emotions such as fear, greed, or herd mentality often override rational decision-making. Even experienced investors may succumb to market sentiment, especially during extreme optimism or pessimism. Marx highlights that coping effectively requires self-awareness, discipline, and strategies to mitigate emotional bias. This is why risk management, patience, and adherence to investment principles are critical. Another limit is the constraints imposed by institutions or mandates. Investors managing funds for clients, institutions, or regulatory purposes may face restrictions on asset allocation, leverage, or liquidity. Even if they recognize opportunities or risks, these constraints may prevent full exploitation of cyclical conditions. Understanding these limits helps investors set realistic expectations and avoid frustration. Marx also notes that not all cycles are perfectly predictable or uniform. Economic, credit, and profit cycles vary in length and intensity. The interplay between cycles can produce unexpected outcomes, creating opportunities or risks that deviate from historical patterns. Investors must remain flexible and avoid rigid strategies that assume cycles behave exactly as they have in the past. Finally, Marx stresses the importance of humility. While knowledge of cycles provides an advantage, markets are inherently uncertain. Accepting the limits of control allows investors to act prudently, avoid overconfidence, and focus on what they can manage: risk, diversification, patience, and disciplined positioning. By recognizing these boundaries, investors avoid catastrophic mistakes and are better prepared to capitalize on opportunities when cycles turn. As we move to the next chapter, we will explore the cycle in success. Even achievements in investing and business are influenced by cycles, and understanding this helps investors and managers recognize patterns, avoid complacency, and sustain long-term results. Chapter 16: The Cycle in Success. Howard Marks explains that success, like markets and profits, follows a cyclical pattern. Periods of achievement are often followed by challenges, and triumphs can create vulnerabilities. Understanding the cycle in success is crucial for investors, managers, and anyone navigating complex systems, because it helps maintain perspective, avoid complacency, and prepare for inevitable changes. Success often breeds confidence, which is beneficial but can also be dangerous. When individuals or organizations achieve repeated victories, optimism grows. Decision-makers may assume that current strategies, risk tolerances, or approaches will always work. Marx warns that this overconfidence can lead to excessive risk-taking, poor judgment, and vulnerability to downturns or unexpected shocks. Recognizing the natural ebb and flow of success encourages humility and careful evaluation. Conversely, periods of setbacks or failure often create fear and doubt. While uncomfortable, these phases provide valuable lessons. Investors and managers who study losses, missteps, or market declines can gain insight, refine strategies, and emerge stronger. Marx emphasizes that understanding the cycle in success allows individuals to avoid overreacting to either extreme: complacency in good times or panic in bad times. The cycle in success is closely linked to market and economic cycles. Booming markets can elevate returns, reinforce confidence, and create a sense of invincibility. Market downturns or economic slowdowns can challenge even highly successful businesses, testing strategies, resilience, and risk management. By seeing success as part of a cycle, investors and managers can remain disciplined, prepared, and adaptive, regardless of current performance. Marx also highlights the role of psychology in the cycle of success. Human nature tends to exaggerate both achievement and failure. Praise, accolades, or rising profits may inflate perception of invulnerability, while setbacks can create disproportionate fear. Understanding these tendencies allows individuals to remain grounded, make rational decisions, and resist letting emotion dictate behavior. Another important point is that the cycle in success is cumulative. Previous achievements can create advantages, resources, reputation, knowledge, but they can also mask underlying weaknesses. Similarly, past failures can provide lessons that prevent future mistakes. Recognizing this interplay encourages long-term thinking, measured risk-taking, and strategic planning. Marx stresses that maintaining awareness of cyclical patterns in success is essential for sustainability. Investors who understand that gains are often followed by corrections and that failures are temporary if managed wisely are better equipped to navigate uncertainty. This perspective fosters resilience, encourages disciplined decision-making, and helps prevent the extremes of overconfidence or despair. Finally, Marx links the cycle of success to the broader market cycle. Just as profits, credit, and investor psychology move through phases, individual and organizational performance is subject to ups and downs. Awareness of this pattern allows for proactive management, informed positioning, and the ability to capitalize on opportunities while mitigating risks. As we move to the next chapter, we will explore the future of cycles. Understanding past and present cycles helps anticipate trends, but Marx emphasizes that investors must also consider evolving conditions, emerging risks, and new dynamics shaping markets in the years ahead. Chapter 17: The Future of Cycles. Howard Marks emphasizes that while cycles have repeated throughout history, the future of cycles may differ in timing, duration, or intensity due to evolving economic, technological, and social factors. Understanding the potential changes in cycles helps investors anticipate shifts, manage risk, and position themselves strategically in an ever-changing market environment. One key point is that no two cycles are identical. Economic conditions, government policies, technology, globalization, and demographic trends create new dynamics that affect how markets behave. While historical patterns provide insight, Marx cautions against relying solely on the past. Investors must combine historical knowledge with an awareness of current and emerging factors to make informed decisions. Technology and innovation, for example, can accelerate or amplify cycles. Advances in communication, trading algorithms, and financial products can spread optimism or fear more quickly, making markets react faster to information. Credit availability, liquidity, and investor sentiment may fluctuate more sharply in modern markets, creating both heightened risk and opportunity. Marx stresses that investors who understand these influences can navigate volatility more effectively. Government policies, central bank interventions, and regulatory frameworks also shape future cycles. Interest rate policies, fiscal stimulus, or liquidity support can extend expansions or cushion contractions. Conversely, changes in regulation or taxation may alter risk perceptions and investor behavior. Recognizing these levers allows investors to anticipate potential cycle modifications and adapt strategies accordingly. Another important aspect is globalization. Markets are increasingly interconnected, meaning that economic or political events in one region can influence others rapidly. A slowdown in one major economy can ripple across markets, impacting profits, credit conditions, and investor psychology worldwide. Marx emphasizes that understanding global interdependencies is vital for assessing the scope and impact of future cycles. Investor psychology remains a constant driver of cycles, even as other factors evolve. Greed and fear, optimism and pessimism remain fundamental influences. Marx highlights that the pendulum will continue to swing, but the speed and amplitude may change. Investors who monitor sentiment, understand behavioral tendencies, and remain disciplined will continue to gain an advantage, even in changing market environments. Marx also notes that emerging risks, climate change, geopolitical instability, and technological disruption may introduce new cycle dynamics. While these factors are unpredictable, understanding their potential impact allows investors to build resilience, diversify portfolios, and adjust strategies proactively. Being aware of evolving conditions reduces vulnerability and enhances the ability to capitalize on opportunities. Finally, Marx emphasizes that mastering the future of cycles requires a blend of historical perspective, awareness of current trends, and humility. While markets evolve, the fundamental principles of cycles – economic, profit, credit, psychological, and risk – remain relevant. Investors who integrate this knowledge with flexibility, discipline, and long-term perspective are better prepared to navigate uncertainty, manage risk, and achieve sustained success. As we move to the final chapter, we will summarize the essence of cycles. Marx distills his insights into key principles, showing how understanding cycles can guide investors in every phase of the market and in life itself. Chapter 18: The Essence of Cycles. Howard Marks concludes by distilling the essence of cycles into fundamental principles that guide successful investing. While each market, economic, and credit cycle is unique, the underlying patterns, behaviors, and interactions repeat. Recognizing these patterns allows investors to make informed decisions, manage risk, and capitalize on opportunities consistently. At its core, the essence of cycles is interconnectedness. Economic growth, corporate profits, credit availability, investor psychology, and asset prices all influence one another. Booms are fueled by optimism, rising profits, easy credit, and confident investors, while downturns result from pessimism, falling profits, tighter credit, and fear. Understanding this interplay helps investors anticipate trends, position portfolios strategically, and respond intelligently to changing conditions. Human behavior is central to the essence of cycles. The pendulum of investor psychology, swinging between greed and fear, euphoria and panic, amplifies both booms and busts. Marx emphasizes that emotional swings often exaggerate market movements, creating opportunities for disciplined investors who act contrary to prevailing sentiment. Recognizing the emotional component of cycles is as important as analyzing economic or financial fundamentals. Another key aspect is risk awareness. Cycles are inseparable from risk. Periods of optimism often coincide with underestimated risk, while periods of fear exaggerate perceived danger. Successful investors assess both objective and perceived risk, adjusting exposure and strategy to protect capital and exploit opportunities. Patience, discipline, and humility are essential in navigating these fluctuations. Marx also highlights the importance of positioning. Investors cannot control markets, but they can adjust exposure, diversify, and allocate resources based on where the cycle stands. Recognizing extremes, both highs and lows, allows investors to act prudently, avoiding overconfidence during booms and seizing opportunities during downturns. Cycle-aware positioning enhances long-term performance while reducing the emotional impact of volatility. The essence of cycles is also about learning from history without being enslaved by it. Past cycles provide insights into patterns, behaviors, and outcomes, but each new cycle is shaped by contemporary conditions. Marx advises combining historical perspective with awareness of current trends, technological shifts, policy changes, and global factors to make informed decisions that respect both continuity and change. Finally, Marx reminds investors that cycles are a natural part of markets and life. Success, failure, profits, losses, optimism, and fear are all temporary states within a larger rhythm. Awareness of this cycle fosters resilience, discipline, and long-term thinking. By observing, understanding, and respecting cycles, investors gain an advantage, manage risk effectively, and create lasting value over time. In conclusion, the essence of cycles is simple but profound. Everything moves in phases, extremes create opportunity, and knowledge combined with discipline allows one to navigate uncertainty wisely. Mastering cycles is not about perfect timing. It is about preparation, positioning, and perspective. Marx's teachings equip investors to see the patterns, understand the forces, and act intelligently in every phase of the market. This completes the audiobook-style elaboration of all chapters in Mastering the Market Cycle. The book's insights provide a framework for understanding cycles, managing risk, and achieving success in investing and life. If you found this guide helpful and want more insights into investing, market cycles, and financial wisdom, make sure to subscribe. Hit the subscribe button and turn on notifications so you never miss an update. Stay informed, stay disciplined, and let's navigate the cycles of markets and life together.